Yeah, this stock market's definitely correcting. It's looking like it's heading towards a crash. The sky does seem like it's falling. So I went to investing.com to see what the deal is and why the whole market's red. US consumer confidence deteriorated for a third straight month in February, and the latest sign that American households are fretting over the effect tariffs and inflation could have on the path ahead for the wider economy. Everything is red. Well, almost everything. There is one ETF that's nice and green while everything else is red and crashing super hard. That would be SCHD, and it's actually up about 2%, where almost everything else is falling. Which is why I suggest that you invest in that 3-fund portfolio to keep your portfolio nice and safe and balanced and have a very solid balanced approach. SCHD is a very solid defense for when tech stocks or the high growth stuff does start to take a decline, and that's what we're seeing right now. Palantir's down about 30% on reports that the government's going to cut spending, and also that the CEO and other executives have been selling a massive amount of shares. The S&P 500 overall is down over 2.65% in the past couple days. QQQM, the NASDAQ 100 ETF, is down almost 5% in that same period. Bitcoin has dropped a massive 10% and is all the way down under $90,000. As I've said numerous times in my videos and in my Patreon group and just to whoever will listen, the tech sector at some point is going to hit a slump, and there's going to be a portion of time where it just has to stop growing as fast as it's been growing, let everything else catch up, and during that time, the tech sector is going to drop. You can see here that the unwinding of the AI trade is weighing even on the broad market, but specifically hurting the NASDAQ the most since that has the most exposure to the tech world. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So what's going on and why are we seeing such panic, and even more, how should we invest this year? In the bond market, treasury yields pulled back as investors herded into investments that are generally seen as safer when prospects for the US economy look rockier. They've been swinging sharply since President Donald Trump's election amid uncertainties about how policies on tariffs, immigration, and taxes could affect the global economy. Trump has antagonized US trading partners recently, threatening to raise tariffs and inviting them to retaliate with import taxes of their own. Trump said Monday that tariff hikes on imports from Canada and Mexico will move ahead after a 1-month delay. Now that one is a big one. Financial markets hate uncertainty. They can deal with a plan even if the plan looks a little bit negative, or at least we can at least see what is supposed to happen. But when it's uncertain, when all we're doing is sitting here going, well, if this happens, then this might happen, or if this happens, this could happen, that's the worst thing for the stock market, and that's what we're seeing today, because investors are fickle. When we don't know what's going to happen and we're waiting on the edge of our seats, any little piece of information that even looks a little bit like bad news scares investors out of their positions, and then that in turn scares even more investors out of their positions. Well, the stock market has been selling hard lately. Wall Street is falling again Tuesday as US households get more pessimistic about the economy because of inflation, tariffs, and other policies coming from Washington. The US stock market has been sinking since the middle of last week after several weaker than expected reports on the economy thudded onto Wall Street. On Tuesday, the latest report said confidence among US consumers is falling by more than economists expected. But I did some digging and I have some thoughts on this. Let's hear what Tom Lee had to say in this short clip, which is actually very interesting, and then I'll give you my insights and further what to actually do with your investing.
Is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations, that was unchanged, but the 5-year expectations moved higher too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So basically, a lot of the issues that we're seeing in the market right now are all stemming from emotions. People are selling off like crazy because it's like dominoes. One piece of bad news gets a certain group of investors spooked, and then they sell. Then another piece of bad news comes out, and that gets even more investors spooked, and then they sell. Then these other investors see that a stock's down 3% or 5% because people have been selling, and so then they sell. And then all these sells are now triggering stop losses for other people when they didn't even actually want to sell out of the stock. They just had that set there. And so all these triggers are happening, and so all these sales are happening, and it looks like everybody's selling out of the market. It's really just one big emotional overreaction and chain reaction. Every year there's a reason for the stock market to fail, or for us to have the biggest recession of our lifetime, or for us as investors to definitely get out of the stock market and wait until this passes. This graphic from the Market Hustle said it best. In 2015, the reason not to invest would have been the global stock sell-off, then the huge issues surrounding Brexit in 2016, then major hurricanes in 2017, then the trade war in 2018, then the repo market blowing up in 2019. In 2020 was that little thing called COVID-19. In 2021, there was a supply chain crisis, and then rate hikes in 2022, then huge bank failures in 2023, and the AI bubble fears last year in 2024. Now in 2025, there's fears over the tariffs. But just look at this. In that period, those 10 years, the S&P 500 has returned 202.8%. Block out the noise. Listen to what Tom Lee says here about the current and expected turbulence at these levels, and actually something that's going to help the market, and it should make the market skyrocket very soon. Then I'll explain what we should be doing as investors in these climates.
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off two back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
So here's the thing, everything surrounding that uncertainty that I talked about from before. All of this is what if. If you're a long-term investor and you don't need the money like in the next couple months or even in the next couple of years, then all of this should just be disregarded and just looked at as noise. If the market continues to drop and continues to correct from the unsustainable track that it was on, this should excite you as an investor. It definitely excites me as an investor. If your whole goal is to put money into the market and let it work for you and grow to much bigger than it is today, then you want to buy in at lower prices. The stock market's the only place where people complain about getting cheaper prices. The S&P 500 is not any worse of an index than it was a couple of days ago, but now you just get it at a cheaper price at 2.5 to 3% on sale. That's just a deal. If you've done your research and you believe in the company or ETF that you're holding, and you also have an emergency fund built up, and you have very, very low debt or no debt, then this shouldn't worry you at all. Yes, it's not fun to look at your investing portfolio and see that it's down a couple percent or a couple hundred or a couple $1,000s, but this is short-term thinking, and what we're investing for is long-term. Now, if you absolutely do need that money in the next couple of months, then you definitely want to do what I've told you to do all along, which is get that money out of the market and have it in something stable like a high-yield savings account or something. If you absolutely need the money in 3 months, it's not a smart move to gamble because there is a chance that the market could drop, like we've been seeing. But right now the market is down, it's correcting. It hasn't hit a crash yet. It still has a long way to go to be considered a crash. A crash is about 20% of a drop, and we're nowhere near that yet. I'm not saying that we can't get there by the end of the year, but we're not there yet. All this is a dip, and I love buying the dip. I'm continuing to dollar cost average heavy into my 3-fund portfolio and also into a couple of companies that I firmly believe in. I really like Microsoft, Palantir, and Berkshire Hathaway as my top 3 that I'm putting the most amount of money into during these dips. But overall, my portfolio, the vast majority is in the 3 ETF portfolio with only about 10% or so in individual stocks. I love investing that way because when things are down like crazy, like Palantir being down 30% and the whole AI market down 10 or 15%, my portfolio overall is only down like 1 or 2%. And so I'm not seeing these huge swings. And so I feel much better. I don't have as much anxiety as some other people that are investing a lot more into those types of things. To see more information on the best 3-fund portfolio on the market, check out this video here or watch this video to keep you going strong in your investing journey. And remember to keep investing simplified.